Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The highly anticipated USDA report was finally released, and as we can see, the market has had a very huge downside response to the news. We'd spoken on how the market had given us a very big downside movement in conjunction with very strong momentum to the downside, and as long as the market did not cross the 12.9 barrier overhead, we were looking for the market to give us another potential leg to the downside. For the September corn contract, we had overhead resistance at our 1x1 angle, and given that we had entered into our time factor reversal zone, after having moved up into our zone, the market has been moving sideways with the projection of a potential downside leg. The market has given that to us now, and the potential for a retest of previous lows is now on the horizon, although we do have potential support sitting at about 357. For September corn, that key area that we had spoken of before was a volatility-based resistance band overhead, with resistance sitting in the range of 373 to 380. We had our 180-degree mark at 381, and as you can see, upon touching the lower band of volatility-based resistance, the market did find it challenging to try to get through. And upon breaking back below 371, we did find a very nice precipitous drop. Currently, we're sitting on support near 361.5, but it does appear that the market will in all likelihood continue a bit lower, as we talked about that 357 being the next key area of support. The December contract is moving in concert, and as you can see, our 1x1 angle here was very good resistance. The market over the last couple of days did manage to move up to our 2x1 angle, but that's where the market did fail, and we do see our point of control level at 370 for the December contract as our next potential leg. In the event that we find a close below 370 early in the week next week, we would look for a retest of previous lows near 350 at a minimum. Volatility-based resistance did its job for the December contract as well. We can see between the 385 to 392 half number where the resistance was key. The market made its way up to that 385 number and has since failed. And now we have our next potential time factor sitting on August 13th for the December contract. The market could very well continue to drop through this number and find additional energy on the way down. And the next key support level we'd be looking for December sits at 360. The most anticipated move that we'd been looking for is in the soybean complex. Much has been made of the recent tariff war between the US and China, and as we can see, the market came up and made a high near our 970 half key resistance number, came down to our time factor of August 3rd, gave us a slightly lower high, and from here we can see that the market responded to the USDA report with a very strong move to the downside. We do have a point of control level sitting at 851 half. And if this market does trade below 851.5 on Monday or Tuesday, we do anticipate a retest of previous lows is likely. Our resistance zone overhead held up very well for the September contract. And again, we spoke about that lower high that happened right up against the lower region of volatility-based resistance. And the market has made a very precipitous move to the downside. Despite the back and forth between the news of the tariffs, etc., affecting the soybean market, part of our contention was that the supply side of the market suggests that the market's going to have a very difficult time of recovering even if China were to re-enter and start buying soybean again. That being the case, we can see very well in conjunction with the time factors and resistance levels that we had, that the market did respond in kind. Much of what we're seeing is that the market was moving up in terms of buy the rumor and sell the news type of deal. The huge nature of the drop today is significant, and we do anticipate continued movement to the downside with the retest of potentially of $8.30 and even getting down to about $8 for soybean as we move closer and closer to the harvest. The next time zone of significance that we're looking at for the November beans contract sits at the end of August, near August 28th. Wheat futures continues to give us much of what we've been looking for, with the market having given us a significant high previously and a marginal break that had moved up to test close to the 595 number. From here, we would anticipate that the market would at least consolidate with the potential of moving down. We do think that the final leg could very well be in for wheat, but from here, we're looking for a marginal sideways consolidation at the very least, with the possibility of a move down to retest the 180-degree mark near 524. As had been the case for both corn and soybean, volatility-based resistance did its job very well, with the market coming up against the 595 number, which is the bottom end of volatility-based resistance. The market did test that area and then failed from there. Our next support level actually happens to land at our volatility-based support zone, but the bottom end of that zone sits at 530, with the top end very close to the 90-degree mark of 547. The market looks to make its way down. That 180-degree mark alongside our sinusoidal wave looks to be somewhere in the neighborhood of 524, 525, where we're looking for key support to set in. The US dollar gave us that breakout move that we were looking for that breaks above the $96 mark, and the market now is approaching $96.60. From here, we can see that the market had been in a sideways consolidation with a very tight zone with a breakout to the upside. This tells us then that the market could very well continue higher to test maybe somewhere in the neighborhood of 97 to 97.5. An N-band extreme did post, which suggests that the market may find a bit of resistance once it gets to that 97 number, but from there we would simply monitor to see the way in which the market continues to trade. Looking at the weekly chart, longer term time horizon, we can see now that the market very much has cleared the volatility-based resistance band, has given us an SR3 signal, but we do think that the potential for continued strength is possible, especially if this formation here ends up becoming a continuation pattern where we see the length of the move into the market is what's mirrored on the outside, suggesting that the US dollar could very well make a run up to about 100 or so. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next time.